Hi, I'm Ken Murray from Finance Solutions, and thanks for taking the time to watch this short video, which is intended to give you a brief insight into what will be discussed ahead of your mortgage protection review meeting. As you'll be aware, when you're drawing down a mortgage, the bank have stipulated that you must have a protection policy that will pay off the mortgage if you die. The policy required should be enough to pay off the mortgage in full. So the question most people then ask is this life insurance and is mortgage protection the same thing? Well, as you're insuring your life, the answer is yes, but it is a very specific form of life insurance. As your mortgage decreases over time, the amount covered on a mortgage protection policy is designed to decrease in line with it. So as you get older, the amount outstanding on the policy is decreasing. If you die during the term of the mortgage, there should be enough protection on the policy to ensure that the mortgage can be cleared. But once that policy pays out, it is finished. There are no other benefits that will survive. Therefore, in the case of a joint application, if one of the partners died, then the mortgage would be paid off, but there will be no further life insurance outstanding on the policy for the other partner. The main advantage of a mortgage protection policy is its cost. Because the amount you are being insured for decreases over time, so as you get older, the amount the insurer is covering you for is less, then naturally that will be cheaper than a traditional life insurance policy that would insure a set amount for the full term. So is this type of cover sufficient on its own? Well, this will be a decision you will make yourself. We will be able to give you some alternative options that not only protect you as required for the mortgage, but also provide life cover that may suit your personal needs better whilst also protecting the mortgage. For example, a level term policy. This is a policy that does not decrease. So if you had a mortgage of $200,000 over 30 years, the policy would start at that level and stay at that level for the full term of the policy, that is 30 years. In addition, for joint applications, this would be a dual life cover, meaning it could potentially pay out twice. So, in a working example, if in 10 years' time one of the couple died and there was €150,000 outstanding on the mortgage, the policy would pay out €200,000. The bank would only have call on the €150,000 outstanding, so the balance of cash, €50,000, would go to the surviving partner, and also they would remain covered for the outstanding term of the policy for a further €200,000. Again, this will be discussed in more detail in the review, but I hope there's enough information here to get you thinking about what suits your needs best. Now, in addition to the life policy, my job as a financial advisor is to make you aware of other ways to protect yourself. The policies I have just outlined focus specifically on protecting you against death. So, in reality, you're protecting the bank because they just want their money back if you die. But what would happen if you got a serious illness that kept you out of work for a long time or maybe even permanently? The bank will still want their payment every month. They won't give you very long before they will put you under pressure to make the repayments. So how can you protect yourself in this eventuality? This is where a serious illness policy comes in. What this would do is pay out an amount that you choose to insure yourself for if you got one of the 44 illnesses covered under an Irish life policy. You can choose to protect yourself in full against a mortgage so that all of it would be cleared, or maybe half in a situation where it is a joint application. This would be your choice, and again will be discussed in more detail in the review. For now though, you need to ask yourself the question, do I want to protect myself against this and ensure me or my family would be financially secure if I got a serious illness? Now bear in mind, a serious illness policy is designed to help you as you recover, and over 90% of claimants over the last 6 years with Irish Life have survived the serious illness event. So as you can see, this type of cover really is for you. The bank don't request it, they just want to know if you pass away that they have their money back. But if you get sick, you're on your own. So you must decide if this cover is important to you, but bear in mind this statistic. You are 4 times more likely to get a serious illness than you are to die before the age of 65. I hope that's given you a brief insight into what you can expect to run through in your upcoming review. It's always important to take a look through the brochures for the relevant cover I have outlined. And again, if you can do that prior to the review, it will provide you with all the information you need so you can address any questions you might then have in the meeting. Thanks again for watching.